We always start with analyzing the price action we had recently. And in this case, up until this high, we had an uptrend. The uptrend is not hard to notice because of the swing points we had. Swing points of higher highs and higher lows. On uptrends, one of the simplest ways is to identify demand levels that are basically the pullbacks before the market started going up. For example, this would be a demand. The price will usually pull back sometime in the future inside these levels and bounce to the upside. As we see here that it pulled back, hit the level with a wick, and quickly went up. Now this upside push, as long as it pulled back down before going up, it should leave another demand. We can see again that the price pulled back into the demand and bounced to the upside, breaking the last high. This upside push had the pull to the downside, so it leaves another demand. Now what is different about this demand is that we can see that the next downside pullback did not fill this demand, leaving it active or not liquidated, while the other ones filled and liquidated. When a demand fills, it liquidates. That means that you can't use the same demand again. This is going to be a huge key factor that you must remember for the rest of this video. Now we see that bearish momentum came into the market with a downside push, breaking down this demand, and also breaking down below the last low. A break of the last low creates a lower low, and a lower low is a swing point of a downtrend, so this signals a trend shift from a previous uptrend into a potential upcoming downtrend. There was also no demand found on this low, because the demand is the last bearish candle before the impulse to the upside. But that needs to be as close as possible to the low, and the only bearish candle on this pullback is literally near the high. So that can't be considered as a valid or high-quality demand. But now back to the main topic, which is that when a downtrend begins by breaking the last low, demand levels invalidate because it makes no sense buying a demand that has a high probability of going down. Instead, it's supply levels that now validate, and they are identified on the highs and more specifically on the last bullish candle, before the market started to impulse to the downside, which on this chart it's quite simple to notice. It's this candle right here. The logic of the supply is that on downtrends, the highs are not supposed to break. They're protected highs, and when the market pulls to the upside, the price should end below the last high and not be able to break above it. It needs to end below, oftentimes on a supply, which is why these supply levels allow for potential sell setups. Now the question is, where would the stop loss and take profit levels make sense to place? The stop loss is the easiest one to think of. The most logical placement is above the last high since we do not expect it to break to the upside. And what about the take profit? Again, the most logical placement is below the most recent low, since the swing low of the downtrend is basically repeated lower low formations. A lower low means that the market constantly breaks down the last low, so that's why it's a logic placement. But what if you want it lower? Especially since we have a low risk-reward ratio here, not even a 1-to-2. Well, we can place it below the last lows, which are these ones. But if you remember, these lows had demand zones attached to them. We had a demand here that filled, and also got one above that also filled. The fact that they filled is extremely important, because they basically liquidate and become inactive, so it becomes quite unlikely that the price will bounce to the upside from the same demand levels. This is important, because if they wouldn't be liquidated and filled before, there would be a way higher chance that this downtrend was actually just a pullback for the price to fill these lower demand levels. If that happens, that invalidates the downtrend, which also means that we get stopped out of this setup, basically losing it. But since they got filled already, chances are they won't respect again. And knowing this allows us to target a lower level for the take profit, basically below those demand levels. So we got an upside movement, hitting the supply, and eventually it drops down quite aggressively, closing the setup on the take profit target. All it did is to basically hold the swing points of the downtrend, which are lower highs that we had here, which protected the sell position from the stop loss, and lower lows that kept holding, which is what actually managed to close the winning setup. Now when it becomes interesting is when two traders see two different things. Let's say the first trader analyzes the external trend. He sees this as a straight upside movement, from a swing low into a swing high, and from the swing high it pulls down into a low, then tries to continue higher, but it breaks down shortly after. It's the swing points that matter, because this last downside movement broke below the last swing low. So whatever trend this market was following before, this is now a trend change into a downtrend. And why a downtrend? Because we have a confirmed lower high swing point, and also a confirmed lower low swing point. When you have these two combined, that's basically a market that's following a downtrend. And since the last swing point is a lower low, after a lower low, a lower high should be expected. A lower high means that the market cannot break above the last high, and this being the last high, this becomes a protected high. So far, it's quite similar to the last market. The same theory applies here as well. So if the pullback shouldn't break the last high, that means that it needs to end below, usually on a supply level. So we just identify the supply that's attached to that protected high. Here it's also not hard to identify it, being the last upside candle before the downside impulse. And it's around this level where the upside pullback should end, so it can continue the downtrend by holding swing points of a lower high, which should be the level the pullback ends on the supply, coupled with a lower low, which is the break of the last low that we can see here. So again, similar as the previous market, we plan the sell setup from the supply. The logic of the stop loss and take profit targets follows the same theory as before, the stop loss being above the last high, and take profit below the last low. This is the plan for the first trader. Let's see how the other trader would analyze this market. This one also analyzes the internal trend, which are the micro trends inside of the macro trends, basically the small movements that are inside the bigger movements. With this analysis, we notice that at the beginning we have an uptrend, and on uptrends we have demand levels that are found on the lows, especially on higher lows. Here it might be the first one that we can see on this chart. Then there is also one above, taken from the bearish candle before the market started pushing to the upside. There was also another demand above, right here, but this one already got invalidated since we see that it basically broke it down. So we're left with two available demand levels that did not get filled yet. But there is also a supply right here. So this becomes complicated because they're opposites. Supply zones favor sell setups, but demand zones buy setups. When this happens, you always want to zoom out in price to have more chart data. In this case, if we also clean the chart and redo a high time frame directional analysis, we will see how this market is following a larger time frame uptrend that started the moment it broke above this high. And basically what is happening lately is that it's pulling back down. And based on the theory, an uptrend ends its pullback on a demand or support. If we apply this into this market, that means that the demand levels might be the level that validate. And also compared to the last market where the demand levels already got filled and liquidated before, right here these demand levels are not filled yet. This scores it even higher for the demand levels. Now for the sake of education on this video, we will test both, the supply but also the demand, and see which one works. And if both work, which one worked better. The supply is kind of already planned. What we can do at most is to place the take profit on the top of the first demand, but not below it since this demand might still be valid. And for the first demand, we can test it out with a buy setup on the top of the demand, stop loss below it. And a very smart take profit is on the bottom of the supply and not above it, since this might be a valid supply. And if the first demand breaks down, we try again on the second demand. Currently sitting on the first demand, which opened this buy setup, and it's also looking like it's slowly bouncing to the upside, but we need patience to see if it keeps going, or if it just fails. I will take the supply out for now until this setup closes, or until we hit the supply. Hits into the supply, meaning the buy position is closing on a win. Now we try the sell setup since the price is sitting on the supply. Now also because the first demand has filled and liquidated, it means that the price should not bounce from the first demand. This allows for a better take profit target, which also equals to a similar risk reward as the buy setup had. This allows for a better take profit target, which also equals to a similar risk-reward ratio as the buy setup had. And the sell setup is the one that invalidates, the market breaking above it and stopping the setup out. The demand had more confluences that supported it. Now, even if you would have taken both of these setups, you still end up on net positive because with this risk-reward ratio, a win will take out many losing setups. But that's mostly to show you how important these confluences are in validating or increasing the quality of demand and supply levels. I have many of these confluences and a lot of material on the link in the description, if you want to check it out. Also, I highly suggest you watch the previous videos. Hopefully it comes out with great value.